Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
In a turbulent stock market, what's an investor to do? That's exactly what we're going to discuss and our strategy, not only with clients' money, but with our own as well. Same timestamp, same price, same trade. Our strategy works great during uptrends and especially during bear markets or corrections. But what happens when you get a single-digit pullback around negative 8, 9%, not qualifying for a correction? Now, we will always underperform the first 4 to 5 days on a bounce, whether it's a pullback over 8%, a correction over 10%, and especially a meltdown in a bear market. It is the insurance of the meltdown that's crucial, especially with growth stocks, because they get clobbered during pullbacks. In fact, some of these growth stocks were down 20, 30% or more when the S&P only pulled down, I don't know, Don will say it, 8, 9, whatever. So with that, I'm going to turn it over to Obi, Don Kenomi and the team. But first, one mailbag that I want to bring up. This is from MB. And Don has a chart up there that he actually sent us. He actually made this, tile with AI. This is 4/6/26. In a turbulent stock market with a rapidly changing world, events battering your portfolio, who are you going to call? I'm glad I called you, Dan. A big thanks to the Revere team for keeping us afloat and allowing me to sleep well at night. Now, I also want to bring up a reminder that Don sent me an email, a thing to the team. This is a week ago, and I said it on the show last week, but I want to bring it up again. Friday, we got calls from clients wanting to completely exit the market. That's when the market was pulling back pretty strong. Today, we got calls from clients wanting to buy. In both cases, we explained the Revere asset process and how it's a time-tested strategy to thrive and strive in all market conditions. So with that, I'm going to turn it over to Don. Don?
Absolutely, Dan. And you can look at this pullback and re-entry into the market multiple ways, but the bottom line, anybody that listens to us knows what we're trying to avoid and have avoided successfully, and all of our rules are designed to take these bear markets off of the table for any of our clients. The way our approach works is they just don't happen because we've got rules that get us out. Worst case scenario, 4% below the 200-day moving average. So ideally, the market for our approach would then continue a significant bit lower, but that 4% cutoff, 3 to 4%, is the maximum that we're willing to give up on the downside. And we did, for the most part, get completely out of the market that last Friday. And then the market, let's take this off and bring the chart of the S&P 500. So this was 330. This was where we finally pulled the ripcord. Okay, that was Monday. Actually, with 327, we were mostly out. Anything that was left over was out on 330. So let me draw this line here. This is where we're out. How much lower did we go? Not significantly. 330 was on a Monday. And then Tuesday, you had this big bounce higher. And this is when we started getting the calls, the bottom's in, you got to re-engage. And what we do is we follow the O'Neill process. Todd's going to talk a little bit more about this. He talked about it last Friday on the podcast. And now that we've implemented that process, he'll do a follow-up. So the first line is day 1. We're waiting for a day 4 through 7, ideally 4 through 7, sometimes on a third day in rare occasions if it's very powerful. So let's just start counting with the first up day. 1, 2, 3, 4. Here was the first time you could get the 4th. This was the 5th. Now the important thing here, the important nuance is we're looking for, in addition to just the raw price action, we're looking for intraday action and what it's telling us. This was day 3. We failed at the 21-day moving average, went below the purple line, that's the 8-day moving average, but by the end of the day finished near the top and recovered that level. Nice tight action on Monday. That was after Good Friday. Next day on Tuesday, again, early weakness. We undercut the 8-day exponential moving average, moved back into the decline, the now flattening 21-day moving average. As you know from our process, we look to get really engaged if we get above the 21-day moving average. So after the close on that day was Tuesday. That was when the ceasefire was agreed to. And we got the day 6 gap up and follow through day. So this tells us this is the first time to seriously consider getting heavy in the market. We had a couple of levels that we could reference. Mainly, it's important because everybody watches the 50-day moving average. Are we going to hold that level? We undercut it several times during the day, but we did hold it. The next day, we touched it and held it again, and now we're on the 3rd day here. We initially opened higher. We're pulling back a little bit intraday. So far, so good. And Todd is going to show some great stats about what we look for after this follow-through day triggers, because we're looking to build confidence that this is going to work. And I know we could be one Trump tweet away from breaking down out of this structure, but the market told us repeatedly that it was trying to go higher since this first day in the bottom, and we're just judging it by not only the action of the leaders, but also the action of the indexes. We talked last Friday, Connor did a good review of some reentry criteria, and one of the things we pointed out is we want that 821 cross to take place, and that happened yesterday. Again, these are just more and more checks in the plus column as opposed to in the minus column. And believe me, there have been some checks in the minus column, and we'll talk briefly about that. And it's mostly with the software sector completely breaking down as more news came out about different AI models and their impact on whether or not you actually need software and security names. And they've just got completely taken apart. We started or had some positions in one, and those have gotten stopped out. So let's talk about those, because the way I approach this is I keep the 50% exposure to the S&P or 0.5 beta for clients that have been on board for a while. I keep that in the pocket. I don't sell that. I hedge it and then peel the hedges off as we reclaim some of these levels, so that when all the hedges come off, and they finally came off yesterday with the test and the hold of the 50-day moving average, then established clients have a 0.5 beta just on the S&P. And then we look to the individual names that are really working. I'm 0 for 3 on. I started with 15 names. I narrowed it down to 5. I bought 2 of them on the first day. They didn't work. I bought a third one yesterday, and that didn't work. But I've got the index portion holding the portfolio up while I look for additional low risk entries on individual names. Ted and Connor have had a lot more success on the individual names than I did, but they went flat on the indexes. So it's kind of 6 of one, half a dozen of another, how you want to get your exposure as the market rights itself. But eventually we'll end up in the same spot. That will be with half of the portfolio exposed to the indexes and half of the portfolio exposed to leading stocks. Let's talk about the ones that I have that failed, and we'll start with Fastly, which was the big leader going into, we've talked about this multiple times, the big leader, even during the correction. Here's the correction here, and you can see Fastly didn't even know that it was going on. But that software bad news that came out that hit the entire cloud sector took Fastly with it. And it started to break the 8-day exponential. Then it broke the 21-day, and today a hard break, down 18%. Look at how this, you got to be quick on these, man. You just can't say this is, I really believe in the story. This is a long-term hold for me. I am extremely happy about this. This went from, my gosh, 35 at a low today to 22. That's 30+% in 3 days off the top. No matter what gains you had in this, that's unsavory without question. So that was the one that I went into yesterday. The third one, when it undercut and reclaimed the 21-day moving average, stopped out on that this morning with the break of yesterday's low and the 21-day. The second one that I bought was a very strong leading name, DigitalOcean. Just look at the relative strength line here. And again, while it was correcting. So where did I buy this? I bought this after it pulled back a little bit on the first day, broke below the 8 EMA on the second. That was kind of my line in the sand. Sold half of it there. Sold the other half this morning on the break of that. So that's the second one that I bought and got completely stopped out on. And the third one, LNG, which, again, fundamentals and the damage that's been done to the infrastructure in Iran and the U.S. on providing LNG is a great fundamental story, but we go by price. So bought this on a reclaim of the 21-day moving average here, and broke below the 21 yesterday, trimmed half of it. It's at least positive today, but my line in the sand is below the low of that first day for getting out of it. The bad part is the fourth one that I really wanted to strongly consider was a leveraged semiconductor, and I opted not to take that. That's the one I'm wishing I would have taken, as that has gone up 3 straight days. But that's why we keep a 21 over 21 list and a turbo 12 list, as well as a standby list to monitor the overall health. I just got unlucky here, being 0 for 3. A lot of the other names that were on the list that I didn't pull the trigger on are acting fine. I've kind of drifted more toward buying pullbacks, but there have been no pullbacks in the names that are absolutely leading. The ones that have pulled back have been decimated, like with Fastly and DocN that I just showed, and you can add Net and AKAM into there. In fact, that triumvirate that Todd did his presentation on, those all completely got undone. So that trade is shelved for the moment. That being Net is the third one. AKAM, Net, and Fastly were the three. And again, if you have a thesis and it's not supported by the price action, you have to get out. Look at the brutal takedown on this name. So that's where we are in the Grotection portfolio. Ted will talk a little bit more about Turbotection, as well as a leader that we've all got our eye on, NBIS. And let me just reload here. We'll go back to the S&P 500 and say what we're looking at. So right now, Grotection has a 0.5% beta on S&P 500 exposure. That's our core baseline exposure that we want to have as long as we're above the 20-week moving average. Now looking to add to that using some lower term, like 60-minute stochastics, as long as we continue to see the moving averages come up. They're not configured the way we want them to be. Obviously, we want the 8 above the 21 above the 50 above the 200. We've got the 50 above the 200, but it's still declining. This should flatten out and turn up. Maybe toward the end of next week, if action continues fine, you'll have the 21 come up through the 50. We already had the 8 come up through the 21, which is a big check in the plus column for that. So now it's just a matter of giving it time. You don't have to play catch up immediately. And in fact, this is part of what we expect to happen. Our system is designed to outperform across market cycles, but within those market cycles, there'll be different periods ranging from just being in line to major outperformance, and on the downside, moderate underperformance. This slide is 5 years old, and it comes to be true every time it happens. And correction or bear early recovery, which is where we are right now, moderate underperformance is expected because we're coming off the lows. That's what we're seeing. But we had periods of major outperformance, minor outperformance, in line leading up into this. We ended up getting out here we pulled back 9.5% on the S&P 500. So we went into a moderate correction. This is where we end up, like I said, getting mostly flat. We got mostly flat, but we didn't get into the harsh correction or the bear market. The market turned and headed back up to the upside. Compare that with April, where we got all the way down into this minus 20% level. And the moderate underperformance didn't really matter because we had such a big lead because of our where we were in our pullbacks. But we're all right within like 200 basis points of the S&P 500 on the bottom line. That's very acceptable to us. We know that can be made up in a strong market in less than a week. That's protection. Turbo is slightly still above the S&P 500, doing very well. Both portfolios weathered the pullback in line with what our expectations would be. And now we go forward and look for continued strength in the market and continued strength out of leading stocks. So Dan, before I turn it over to Ted, this is your time to clarify or ask questions.
Actually, I thought that was pretty good. But here's the main thing, folks. Like I said at the intro, if you get a pullback from around 7 to 8%, the first 5% is just kind of market noise. It's not critical. Once you start getting to certain layers, we're going to start moving in layers to cash, right? And a lot of times the markets will go down, and the Wall Street hates corrections or even bear markets. So they will try to defend that 10% level, which is that's the classical definition of a correction, right? So at 8-9%, a lot of times it'll come back and bounce about 2 out of 3 to 3 out of 4 times. But once it breaks through that, a lot of times, so 1 out of 3, 1 out of 4, it'll flush and it'll just go way down. And that's what we're protecting against. So once you get the bounce on any large enough pullback, we will underperform those first 3, 4, 5 days because, like Don said, you need that follow through 4 or 5 days or more for confirmation that it's not a dead cat bounce and it's got a much higher probability of continuing going up instead of just rolling back over. All right, Don.
I'm right, Dan. I'm showing back to April of 2025 here, drawing the line where we got out. This is that 3 to 4% range that we're willing to give the market to keep some exposure in. But once that breaks, this is where we got out, and then we re-engaged same way with the follow-through day, same process that we're using now. I also want to point out something. Project Maximus, which is we're working with an outside data firm analyzing market gaps in individual names. And we're 6 months into it. It's a 12-year long beta test process that we're doing. And if this was a full 100% portfolio, it would be exactly what we wanted it to be. So when we wrap this up at the beginning of the fourth quarter in here, this is going to get integrated into our portfolio management process. And it's just statistically based over many back tests, focusing on leading names. Over the last 6 months, the portfolio is up 8% with no more than 25% exposure to the market. So if we'd taken bigger position sizes, it would be being even better. This is in over the same 6 month period versus a 2% return on the S&P 500. So now that we've got the data and the models built for these model stocks for episodic pivots and gaps up, and we know what the expected behavior is going to be, it's going to greatly enhance our returns for our clients. And it's something we're really excited about. I've got my personal money into this just the same way that we do anytime we want to test something. It doesn't matter if it's hypothetical. You got to have real money on the line. We're willing to do that for our clients. And after it's proven itself, it'll go live in the beginning of Q4 when version 5 of the updated Grotection rules goes live. Any questions on that, Dan?
No, that was great.
Yeah, that's Project Maximus. So let's turn it over to Ted, who's going to talk about NEBIUS, and he's pretty excited about this because of some prior action in names. And take it away, Ted.
Thank you, Don. Yeah, so we got this follow through today. Our eyes are on the leaders. They have been, especially during the correction, because that is the best time to track relative strength. And so NEBIUS is one. I don't think any of us own it yet, but we've been hawking it. Just couldn't find ourselves in yet. But we're looking and hoping for a pullback or some sort of new entry in this name. When I see this chart, it reminds me of two charts from the past that we've traded before, and they were pretty big winners. So William O'Neill, one of the people we look up to most and what Revere was built off of, he oftentimes looked at precedents as well to set some expectations. So the first one, Don, can you go to SMCI and bring that back to, let's just say, end of January 2024. Maybe just do January 30th, 2024. And for those listening right now, that is quite distorted. 2020. Yeah, let's go back let's cut off the most of the move, Don, so we can see the base more. That's kind of what I want to emphasize to compare it to the current NEBIUS setup. Yeah, that's perfect. Maybe even a little bit more because MarketSmith sizes it a little bit differently, so we can't see the characteristics of the base that well. Okay, perfect. Yeah, perfect. So you can see this one was even relatively stronger. NEBIUS pulled back to the 200-day moving average, built similar higher lows. You can just see like the jaggedness of this base, how the moves worked in the 6-month base. That's pretty much almost a carbon copy of NEBIUS. 6 months as well. You had a lot of higher lows. You had rallies, and then they pull back, and then they built higher lows along the right sides of the base, get tight, and then eventually break out. And this was on an earnings report. They pre-released earnings, huge revenue, huge earnings, huge guidance, and that's what catalyzed SMCI into new highs. NEBIUS actually made a new high today. So the precedent right now that aligns even better is MSTR of late 2024. If you can go to MSTR, let's just go to December of 2024. We should be able to see the base quite well. And so why this precedent probably aligns even better is because MSTR briefly broke. Actually, let's bring this back to October of 2024 so we can see the base even better. Again, 6-month base. And actually, this is a perfect day to bring it back to. You can see it breached the left side high into new all-time highs, similar to NEBIUS right now. And so a potential scenario I would love to look for is a handle that gets built right here, maybe a high handle, maybe comes back in and pulls back to the 21 EMA. And that could also coincide perfectly with its earnings report in a couple weeks. So now, Don, can you bring it back to NEBIUS? Hopefully the listeners have taken snapshots of these two precedents in their brains. And now when we bring it back to the present day, this is NEBIUS now. You can see you have this pullback, pretty deep pullback, and then eventually you put in the low. Here it was at the 200-day moving average, and we started building higher lows against the 200-day moving average. And keep in mind, yep, Don mentioned it perfectly, or is displaying perfectly right now. The markets are making lower highs and lower lows, and NEBIUS was making higher lows and higher highs. That's a clear telltale sign of relative strength. Also, when the markets broke the 200-day, NEBIUS was holding the 200-day. And there was a catalyst in there too. About a month and a half ago, NVIDIA invested $2 billion into NEBIUS to expand compute. And then that was followed on by a Meta deal. I think it was for $27 billion. That caused a second gap. But eventually it did fall pressure to the markets as well. But again, this ended up pulling back, made a higher low while the markets were making lower lows, held the 200 again. And when the pressure of the markets, the general markets, was lifted in the last week, this exploded to new highs so far. And it got away from us a little bit, just praying, hoping, that scenario happens right there. And that can coincide perfectly with the earnings gap in a few weeks. And that would be a perfect catalyst that could send this into new highs. And just something we're stocking, a leader we're excited about. We know Anthropic, OpenAI, all these frontier model companies are starved for compute. And so there's a huge build out right now. And that's why we see semiconductors and semiconductor equipments acting so well too.
Relative strength new high on the weekly and just eclipsing the highs going back to early 2025 when it didn't have any of these deals in place. It was, more of a contender now proving itself. Great job, Ted.
One last thing. These 6-month bases, I've noticed just over the last few years, they come maybe 2 to 4 times a year. And oftentimes it is best when there's a general market pullback that reveals these 6-month bases that complete their right sides. And I mean, it's a classic maxim. The bigger the base, the higher in the space, especially when it's paired with a general broader theme and catalyst. And we could have both of these coming up soon.
All right. We're going to go over to Todd now. Talked about the leading into follow-through days last week. Now that we're post follow-through day, Todd wants to talk about what we're looking for, the action that would be plus or would be a minus. And we've got a slide to go with this. This is a key data point and what we're absolutely looking at. Connor talked about this in his nightly video earlier this week. Take it away, Todd.
All right. There's two main things we look at when we judge a follow-through day in the upcoming days. The first thing we look at is early distribution as being a warning of that follow-through day. We don't want to see distribution occur after the first few days of a follow-through day, or the failure rate of that follow-through day is extremely high. As we can see, 95% in the first 2 days and 80% after the third day. After 4 to 5 days, that failure rate drops to 30%, which is quite bullish at that point. So right now we're on day 3. Well, Don, would we be on day 2, I guess, right?
Yeah, we're on day 2. This is follow through day is day 1. So we're on day 2. We want to make sure we have no distribution Friday or Monday. Friday today or Monday.
And really the S&P is the index that had the follow through day. I don't believe the NASDAQ traded bigger volume on Wednesday, believe it or not. So the S&P gave us the follow through day. So we will want to look into early next week and not see distribution. The other thing that we're not showing on the slide, we don't want the follow-through day lows to be closed under. So if we get a close under Wednesday lows, that's even worse than distribution. And that window goes out about 10 to 11 days. And basically, if we close below that follow-through day low within the first 10 days, there's about an 88% failure rate. So distribution and closing below the lows are the two main things that we don't want to see at the macro level of a follow-through day. Ideally, we want the first 4 to 7 sessions to be rising on respectable volume, which shows we're not in a one-day wonder. And so far, we've had pretty powerful action. We had a lot of leaders leading up to this follow-through day, and semiconductors, optical. We had edge computing, but obviously software disruption is causing some waves there. So we'll see how those handle this selling. We'll see if Fastly can hold the 10-week moving average, for example. But overall, we got plenty of leaders that are showing some pretty decent strength. Breadth is decent, and we're going to want to continue to monitor the breadth through this. And if we do get pullbacks in the indexes, we're going to want them to be constructive, quiet pullbacks, suggesting normal digestion and not aggressive selling. So we're early in this, but that is what we're going to be looking for the index behaviors in the upcoming few days to the upcoming couple weeks. That's it.
All right. Good stuff, Todd. And pinch hitting for Connor today is Jackson. Jackson, as we do with all potential portfolio managers at Revere, he's running a sleeve of capital, and he's going to talk about how he managed 5 of those trades re-entering the market after the connection. So let's go on down to Jackson. Jackson's so good that Johnny Cash and June sang a song about him. So go ahead, you big talking man. I wonder how many of our
I'm
audience
going to
actually
Jackson.
got that.
Oh, yeah.
I'm going to Jackson. That's right. You know
John
that song,
Dan,
Jackson?
excited to be here today. We'll start with Akamai. That was the first trade. And starting with a trade that actually didn't work here post follow through day in the AI edge space. Bought this 2 sessions ago on the follow through day in the tight area there, just above the prior high to the left at that 113.5 high to the left. Anticipating a fall through higher given the group strength and market leadership during the correctionary period. This name actually gave us immediate feedback and failed yesterday. And the stop on the initial buy, which was a 115 average cost, was below the 21 day. So fortunately, yesterday, it failed below the 21 day, held that 108 shakeout level to the left, that low that tested off of the 21 day intraday, bounced to reclaim the 21 day. And then given the weakness in the group and what Don covered earlier, which was Fastly and DOCN, and all 3 of those failing together, I moved my stop up, kind of choked up on the stop to that low on an intraday basis, and then it refilled through that 108 level. And so given the relative weakness of the group and the relative weakness of the name, considering the market following through and the strength in other leadership groups, I cut this 2% initial pilot buy position out and clearly saved myself the, kind of the waterfall effect here through the 50 day.
Yeah, down almost 14% today. Yeah.
Yeah, right.
Yeah,
so,
there's a reason there's a reason they say the first sell is the best sell, and it's okay to be wrong. It's not okay to stay wrong. Great job cutting these. Paper cuts and we track these stacks meticulously for everybody in house, and it's the big winners that make up for all these little paper cuts. So the important thing is that you don't have a big loss.
Absolutely.
Next
and
one.
just like Don, I was in Dawkin as well and stopped on that yesterday. So trying to play the whole group. Next one is CIFR in the AI data center space. Bought this 2 days ago at an average cost of $15.15, a little bit below in and around the 50 day there, anticipating a reclaim. And the key in here was the fact that it was the data center name or pure data center play, right? Separate of NEBIUS and CRWV, which are hyperscaler data center plays, was up the second most behind Wolf. And WULF was already leading the group out on strength and short-term extended to the upside. So if we don't mind just taking a look at that real quick, this move and base breakout keyed me in that the more laggard names within the group will most likely follow, considering they were still in constructive setups. So bought CIFR on the reclaim of the 50 day. And Don, if you don't mind going back to CIFR, one thing I want to point out here is the weekly chart. And the declining tops trend line that we've been watching for about 5 or 6 months now, just waiting for this name to go. And now it's finally reclaiming the 50-day and then all of its weekly moving averages, and doing so on big volume. This was very different than the Akamai trade in that in the past two sessions, it's given me great feedback and already up over 10% on the initial 2% pilot buy. The goal will now be to pyramid into this name up the right side of the base as it continues to take out key levels and hopefully works out of this launchpad setup here with the 50-day and 200-day and all the shorter term moving averages curling up. Awesome. Moving on to CoreWeave. Great. So bought CoreWeave yesterday, and you can see the volume there that Don just pointed out. We have a double catalyst, and this is the only real pure hyperscaler play along with NEBIUS that has big backing, big contracts, and a big debt and capital allocation outlay. With NVIDIA also having a stake in this name along with NEBIUS. And the news 2 days ago, prior to the market open yesterday, was a $21 billion meta deal. So that meta deal came in and we had big volume yesterday, a lot of fighting, big gap up, fade back into the 50-day where we received support. And then the volume just came in the latter half of the session and ran it back to basically to highs. So actually Todd was buying it, sent the group a message, and I decided to follow him there with an initial 2% pilot buy. And then we had the second catalyst before the market opened today, which was an AI data deal with Anthropic to service Claude. And so the volume was massive. We got a gap up that faded this morning and gave me an opportunity to buy some more. So I bought an additional 3% and am now in with a 5% position at an average cost of $95, up about 9% so far. So big thing here is the run rate on the volume. You can see we're already double average daily volume and have a decent amount of the session left to go. So nice to see it through the Livermore 100 level and reclaiming the 200-day. Anticipate this one following NEBIUS. And Don, real quick, just if you don't mind pulling up the weekly, this is a very similar chart to CIFR in terms of that longer term weekly DTL. Now kind of just testing that level and getting ready to punch through. So.
All right.
Great. Moving on to Qnity. Great. So there were many names in the market, especially semiconductor equipment related names, and a bunch of leaders and balloons underwater that were setting up prior to the follow through day. And so I actually bought this 4 sessions ago with a 2% position on the tight inside day above the rising 10 and 21 at an average cost of 119. So took that initial pilot buy, hoping that this would then continue to hold the 50-day as it has done characteristically to the left. So had to stop at the 50-day or on a close below the 50-day. And we're fortunate enough to survive the headline risk and get a positive gap catalyst leading to a fall through day. And this is just a perfect example of the stock showing you beforehand via tight areas we're ready to fall through. And had it not been for the pending announcement, probably would have taken a little bit more size here prior to the fall through day. But nonetheless, good to have 2% size on and a leading name that's fallen through. Awesome. Moving on to Teradyne. Very similar setup here, as you can see, pretty analogous chart to Qnity. There were many names set up this way. A couple other names off the top of the head were GLW and others. But bought this same sort of thing on the tight day, tight close, where it pushed out prior to the fall through day at an average cost of $313 a share. Started with a 2% pilot position and caught the gap up into the breakout on the fall through day. So leaders lead, and this is a good example of a trade that just gave us immediate positive feedback. And now we'll just be waiting for shorter term moving averages to catch up and hopefully pyramid by this as it makes its next leg out of this stage 2 O'Neill base breakout. Again, you can see the relative strength on these last two names, just absurd. So continue to be diligent and work our way into more leadership names here.
Excellent job, Jackson. That's the way to do it, both with the indexes and with individual names, which is what we really put a high priority on for smoothing the overall equity curve for our clients. Dan, that's it from the tech side. You want to take us on home?
Sure, folks. Listen, if you like what you heard, please tell a friend and a neighbor. Just go to revereasset.com. Up in the right-hand corner, there's a spot to sign up for our newsletter. It comes to you every night. And this podcast we do every Friday morning will come in your inbox Saturday morning. But if you go to YouTube and just search for Revere Asset and hit subscribe, our producer Zach will have this out to you just in another hour or two. And so it comes quicker. Our active traders that are clients, that's the way they do it. And next to that on the website, there's a Contact Us button. You can send us a request to talk about a stock, an idea, or especially if you want a complimentary portfolio review. And you can always call us at 855 Real Wealth. We'll talk to you next week on your money, not their money, not Wall Street's money, your money.
Because it's not about how much you make in the markets, it's about how much you compete.